So that concludes trend lines. Next, we're going to move on to Fibonacci, and how you can actually use Fibonacci to aid you in terms of target and entry points. Okay, so in this section we're going to look at Fibonacci and how you can actually use this to actually plan your trade entries and your trade targets. So let's begin, guys. So here's an overview of how this works. So the Fibonacci rules are simple and repeatable. So what we define as a swing high are 2 candles to the left and 2 candles to the right that are lower than the highest point. Also, a swing low is the lowest candle which has 2 candles to the left and 2 to the right that are lower than that are higher than the lowest point. So I will show you what that looks like visually. So if you have a look here, this point here, let me just show you, let's get the pen out, is the highest point, and these two are lower than this high, and that's what we call a swing high. And this low here is what we call swing low, because these two are higher than that low. Essentially, the way Fibonacci works is that the market moves in waves like this, and it moves in Fibonacci ratios. This is something that we cover in a lot of detail in the applied trading program. So these are pullbacks that are fixed within Fibonacci levels, and these targets are, again, as you saw with the previous examples, very accurate to actually show you where the market's going to go and then pull back. Okay, and I'm going to show you some examples. Here's how it all works. So the market moves in Fibonacci waves in all time frames. Very, very important to understand. So in other words, it's moving like this in all time frames. Even when you get periods where the market's going sideways, it eventually gets to its Fibonacci targets. Okay, so you just got to understand where you are in the market and use multiple time frames to help guide you. At London Trading, we utilize dynamic Fibonacci waves. Okay, you want to think and learn of each wave as one game. In other words, what we want to do is we want to trade this kind of game here, which is a C to D game. Okay, and that's what we're going to cover in the strategy section. So in other words, when we're trading with the trend, we're just looking at this being one game. Our job is to actually capture this bit here or this bit here. Okay, and that's what we're looking to do. So each time we capture it, then you get out, and that's the game complete. Okay, so think of each wave as one game. For a downtrend, the game begins with the highest point on your chart, where you move down from the high, your A, point, to the next low point, your B, and that creates your first down AB boundary. So I'll show you what that looks like visually, but it will basically be something like this: A, B, C, D. For an uptrend, the game begins with the lowest point on the chart, where you move up from the low point, your A, to the next high point, your B, and that creates your first AB boundary. The market then retraces to a Fibonacci level known as your C and extends to your D to complete its wave. Once the wave completes, the old C to D becomes the new A to B, and the game begins. So it's a very dynamic way of doing your Fibonacci's. And to illustrate this is what it looks like. Okay, so B to C is what we call a retracement. Okay, it's the pullback, and C to D is the extension. So this is where, you know, if you want to trade with the trend, you're going to be looking to trade C to D extensions, and if you're happy to trade against the trend, then you could be looking for these retracements. For a downtrend, again, this is the retracement. So the market is basically moving down, but it's retracing that down move here. In other words, it's going up, and it's called the B to C retracement. And then when the market resumes its downtrend, it's called the C to D extension. Once again, if you want to trade with the trend, you'll be looking to trade this move down. So in terms of ratios, what we look for is for pullbacks basically to match extension levels. These are some of the Fibonacci ratios that we use. Okay, so it varies from the 38.2 to the 618, and this is what we call our red zone. Okay, here. And if it gets to our red zone, we simply just target this red zone down here, which is our 1618. If the market pulls back deeper, up to a 78.6, then we are looking for the 127. This one is a little bit more rare, but I'm going to write it in anyway. It's a 118 here. Okay, so if the market pulls back, sorry, ignore that. If the market pulls back to an 86%, then we only expect the market to get down to its 118 extension. And what these ratios basically mean is that you take this move here, A to B, to be 100%, and then we take 61.8 and add it, and that gives you the 1618. 27.2% gives you the 127. If you add 27.2% of that distance from A to B down here, and then 18% for the 118. And all of these are Fibonacci levels and ratios, and they work very, very well in the Forex market. Let's show you some examples of this, okay, how it looks. So here is an example of your A to B to C to D movements. Okay, and I'm going to just start with the first one. The first one, when the market tends to reverse, so this was a downtrend. Obviously you can't see the rest of this chart, but when the market reverses its downtrend, it tends to overshoot beyond its 1618 target. So you can see this was the initial target, and it actually went and created a high point all the way back up there. So once that was complete, then we had a new A to B. Here was our C pullback right here. So in other words, it was within the red zone, and you can see that means our target was up here in the red zone, and that was a perfect hit, and the market pulls back. So you notice how, we went slightly above this area here, but eventually the market came back down, creating a new AB. So this becomes our A, here's our B, here's our C here. So here's an A, B, C, and look at this, perfect hit. Again, here's our D target up in the red zone, pullback was in the red zone, and again a perfect hit, and the market comes off. Okay, and these are not just examples that I've just handpicked and very rarely happen. These happen all the time, guys, in the market, and that's what's amazing about this strategy. So what do you think would happen if you could combine all the above technical tools? If you could get the market at resistance on the third touch of a trend line, 50% retracement on a Fibonacci, a shooting star formation, it then proceeds to break a counter trend line. If you took that trade 10 times, would you feel confident that you would make money with the risk reward in mind as well? Now that's what we're talking about when we say about high probability trades. You're looking for opportunities for when things align. Now you could just trade the Fibonacci, you could just trade candle formations, you could just trade counter trend lines, you could just trade any of them individually. But if you combine the lot together, imagine the power and the probability of that trade working is very, very high. So that's what we believe. If you add the risk reward to these trades, it adds even more reason to take the trades. In other words, if you're going to make more than what you risk, it adds even more to the trade. And that's what we're looking for. We want you to build these high probability setups. Okay, so let's have a look at an example now. So here's an example of what we're talking about. So here's a Fibonacci indicator that's been drawn in for us. So here's our A, okay. This bit up here is our B, and here is our C. Okay, pulls back to the 50% Fibonacci retracement. Here's our 50%, the red zone. Here's our target. We'll have a look at this. Bouncing off a trend line, nice support, nice rejection candle, then we break. Look at our breakout candle there. Counter trend line break, 50% Fibonacci in an uptrend. Here's our target. We buy it there, we target there. I would basically place my stop below this trend line, at least there, or below this low test bar here. And look how perfect it gets to our target, and then eventually pulls back. So you're literally waiting for all these things to line up for a high probability setup there. Okay, and that's what you really want to do. You want to find these high probability setups before you take them. So what we want to do now is really go into the strategy of how to actually apply this counter trend line strategy and how to use it in practical terms in the market.